Welcome to this explainer on how banks create money. We're going to jump right in today because I want to start with a fascinating and honestly kind of counterintuitive scenario. I want you to imagine that you just received a payment and you decide to deposit $1,000 into your everyday bank account.
Let's call our depositor Alice. So Alice deposits her $1,000. A few hours later, she pulls out her smartphone, checks her banking app, and boom, she sees her balance has gone up by exactly $1,000. Everything seems perfectly normal, right? Naturally, Alice, like most of us, believes that her money is just sitting right there in a digital vault, just waiting for her to use it.
But if we actually follow the dollar, we can see what happens next. The bank doesn't just leave Alice's money sitting idle. No way. Instead, the bank takes a portion of it, let's say $900, and lends it to someone else who just walked through the doors wanting to buy a motorcycle. This new borrower receives the $900 loan and immediately hands it over to the person selling the motorcycle. Finally, that seller takes their newly earned $900 and deposits it into their own account at a completely different bank.
Now, a literal mathematical paradox has just occurred. Alice checks her app, and she still has full access to her original $1,000. But the motorcycle seller also checks their app, and they have full access to their $900. If you add those up, the banking system now contains $1,900 in available deposit money. At first glance, it almost looks like the money just magically multiplied. How can the exact same banking system now contain both amounts at the very same time?
Okay, let's dive into this. Has money actually been created? In a very specific, literal sense, yes. Commercial banks have just created money out of thin air. I know, this idea sounds strange. Most people assume that only the government, printing physical bills, creates money. But in modern economies, commercial banks play a massive role in money creation. And understanding this is absolutely crucial. It's the key to understanding inflation, interest rates, and honestly, the entire economy.
So, in Section 1, we're redefining modern money. To understand this paradox of the $1,900, we first have to fundamentally rethink what money actually is in the modern world.
When most people hear the word money, they immediately picture physical cash. They think of paper banknotes and metal coins clinking in their pockets. But we don't really live in that world anymore. In modern economies, the vast majority of money simply exists as digital money. It's really nothing more than numbers on a screen inside checking account balances.
And this brings us to a crucial definition. The money supply is simply the total amount of money available within an economy. So when you look at your checking account balance, that digital number isn't just a receipt for physical cash stored somewhere in a basement. It is actively considered part of the economy's official money supply. Banks don't just store money. They actually help create part of this overall supply.
Moving into Section 2, let's talk about the money creation engine. How exactly do they do it? Well, let's peel back the curtain on the actual mechanism of how banks expand the money supply without ever needing to use a printing press.
Now, what's really interesting about this slide is the term fractional reserve banking. I know, it sounds like intimidating financial jargon, but it's incredibly simple. Fractional just means a part or a piece. Reserve refers to the funds the bank keeps safely available for withdrawals. So it simply means that banks hold a fraction of deposits in reserve and they use the remainder to support lending. That's it. It's a beautifully simple engine.
Let's walk slowly through the multiplier math to see this in action. Remember our example? The first bank gets Alice's $1,000. They keep a fraction, say $100 in reserve, and they lend out $900. That $900 is spent and deposited into a second bank. Now the second bank does the exact same thing. They keep a partial reserve of that $900 and lend out the remaining $810. That $810 gets spent and deposited into a third bank. As you can see, each round of lending creates brand new deposits in the system, getting slightly smaller each time as a little bit is kept back in reserve. No new banknotes were printed, yet the amount of deposit money circulating in the economy has rapidly expanded.
This brings us to Section 3, the limits of lending. At this point, a massive question usually pops into the mind of anyone learning this for the first time. If lending creates money, can banks just create infinite amounts of it?
The answer to that is a firm no. This is actually one of the biggest misconceptions out there. Banks cannot just invent endless wealth. They face strict, real-world constraints. First off, they actually need willing borrowers. They can't lend if no one wants money. Second, borrowers must be creditworthy, like capable of actually paying it back. Third, banks operate under really strict financial regulations regarding capital and risk. Fourth, making bad loans destroys their own profitability. And finally, they're heavily influenced by the monetary policies set by central banks.
And actually, let's clear up another major beginner misconception right here. When we talk about banks creating money, we are talking about commercial banks. These are the retail banks you and I use for daily transactions and loans. Central banks, on the other hand, sit at the very center of the system. They don't deal with the general public. Instead, they manage monetary policy, set interest rates, and ensure the stability of the entire financial system.
It's also incredibly important to realize that this commercial money creation engine is absolutely essential for our everyday lives. Think about it. A bank creates a mortgage loan, and a family buys a home decades sooner than if they had to save pure cash. A business gets a factory loan, and suddenly they're hiring workers, buying equipment, and generating economic activity. Lending and the money creation that comes with it is literally the fuel for healthy economic growth.
Moving into Section 4, we need to look at money versus real wealth. This brings us to a critical realization. We really need to elevate our understanding here from just basic banking mechanics to actual macroeconomic theory.
Take a look at this thought experiment. If a country magically doubles its entire money supply overnight, is that country suddenly twice as wealthy? Just imagine waking up tomorrow and everyone just has double the digits in their bank account.
The answer is, of course, no. And that's because of the massive difference between money creation and wealth creation. Expanding digital currency and deposits is just creating more money. But if you don't produce more houses, more cars, more computers, or more food, you aren't actually any wealthier. Real wealth comes from innovation, human labor, productive capacity, and real physical goods. Money is simply the tool that facilitates the exchange of that real wealth. Money itself is not the wealth.
So the crucial point is this. If the amount of money in the system grows much faster than the actual economic output of real goods and services, you have more money chasing the exact same amount of stuff. What happens? Prices rise. That is the fundamental driver of inflation. It's all about the balance between the money supply and real economic output.
We also need to bust the myth that banks are just sitting in ivory towers inventing free wealth from nothing. When a bank creates a loan, they don't just magically eliminate economic constraints. For the bank, the loan is an asset. But for the borrower, that exact same loan is a liability. Every newly created dollar comes attached to an equal obligation. The debt must be repaid. So the system ultimately balances out.
And this brilliantly illustrates why the banking system acts as the literal heartbeat of the economy. When economic confidence is high, businesses want to invest, consumers want to buy, and banks are happy to lend. The money supply expands and the economy accelerates. But during economic recessions, fear takes over. Borrowers become cautious, banks become hyper-selective, lending slows down, and money creation shrinks. The economic heartbeat slows.
Let's move to our summary and see how this all builds together. If you take nothing else away from this explainer, remember these core truths. Modern money isn't mostly physical cash, it's digital. The commercial banks we use every day actually create this money through the act of lending. They do this through fractional reserve banking. But they cannot create infinite money due to strict real-world limits. And finally, always remember that creating money is not the same as creating real, tangible wealth.
Which leaves us with one final, incredibly important question. If commercial banks are the ones out there creating the money on a daily basis, how do central banks actually manage to control the overall economy? Well, that requires looking at the single most powerful lever in all of global finance, interest rates. And that is exactly what we'll be covering in our next explainer. Thank you so much for joining me, and I'll see you then.